Opendoor reported earnings on Tuesday. Unfortunately, the stock has kind of been tanking since then. I'll be breaking down everything Opendoor, including that earnings report, of course. We'll also be breaking down President Trump's new tariff on India and Apple's bold investment into the United States. Stick around for all that and much more on this week's midweek check-in. As always, if you get value from these videos, make sure to like, subscribe, and follow wherever you listen to podcasts. Now, folks, let's roll. All right, so we got Opendoor's earnings that came out on Tuesday. We had our first positive EBITDA in over 3 years, which is something Eric Jackson has been alluding to. We got a revenue beat. Unfortunately, however, the guidance for Q3 was not that great, and that's really what investors focused on this week. Welcome back to Stonkcast, the market show for the average Joe. Whether you're a diamond-handed degenerate or a more conservative swing trader or investor, we've got you covered. All right, so let's jump right into this article from CNBC. Opendoor tanks after earnings as CEO thanks new investors for increased visibility. After a massive rally in July and early August, Opendoor hit a snag on Tuesday with a disappointing outlook. CEO Carrie Wheeler thanked new investors on the earnings call and said, "We appreciate your enthusiasm for what we are building, and we are listening intently to your feedback." The company said it expects to face a challenging macro environment for the rest of the year and that it's reducing marketing spending. So, basically, as I said earlier, the guidance was not that great. And really, if we take a look at Eric Jackson and one of his tweets that came out right around earnings, he said, "Not a lot of content in the release for Open. They beat after hinting they would. Biggest positive is they guided to basically a flat EBITDA quarter in Q3. Most expected they'd sandbag and suggest a big loss like they typically have. They acknowledge the retail support and how they want to take advantage of it. It really won't matter what Carrie says on the call, how much detail she gets into about their initiatives in AI and proving she's up to this turnaround. The knee-jerk stock reaction in the after hour now is meaningless." So that was what Eric Jackson said when the earnings initially came out. And of course, we had the earnings call. I was on it, listened to, pretty much all of it. And, the nice thing was that Carrie Wheeler did acknowledge the retail interest and basically spoke on a few different things related to the fundamentals of the business that were very, very interesting. They did not hold back anything when they talked about how the real estate market has been tough. They were honest about that. They didn't sugarcoat it. And, we've talked before about how Opendoor is primarily an iBuyer when it comes to real estate. And really at a fundamental level, what they talked about on this earnings call was a shift towards more of a partnership with real estate agents and trying to find other ways to basically increase margins, which has been challenging for them, the margins part, during the slowdown in the real estate market. When it comes to selling homes, it's been a challenge for them. So really, they're not just going to be doing iBuying anymore. They're going to be doing that, but they're also going to be, offering sellers of homes this other option as well, where, they can basically see a second offer from a real estate agent. And so Opendoor, of course, is partnering with those agents. So that was really interesting from the earnings call. And I'm going to break down all the numbers regarding that earnings report that we got. But first of all, I just want to do a quick overview of what we saw on the charts really over the past couple days. Some of the levels I've been paying attention to, those Fibonacci retracement levels that I'm always talking about. The 61.8% level is really a line in the sand, make or break. If a stock can hold there, you're typically going to see a good retracement. If it can't, then you're basically in a scenario where you might be going all the way back down. And so on the daily chart here, as you can tell, this is the 61.8% retracement level, 221. And, as of today, we are unfortunately below that. But if we zoom in, and I'll get in further to the technical side of things as it relates to the chart, because we have a few interesting things that are kind of lining up that I wanted to talk about. But first of all, if we just take a look at the chart from, Friday into Monday, we had a lot of bullish action, which was great. This was Tuesday right here. We had a lot of chop intraday, people, positioning for earnings. And then when the earnings came out, this thing went down hard, folks. Talking over 20% and has not yet recovered. This was Wednesday intraday. We got a push up to that 221 level, acted as resistance, and kind of faded off the rest of the day. So as of right now, that's kind of where we're sitting on the charts. It's not the most bullish thing you'll ever see. But, I think there is still some hope here, and I'll get into that here in a little bit. But first of all, let's take a look at some of those numbers. So basically what I did was I had ChatGPT. I have a custom ChatGPT with a Benjamin Graham style investment philosophy. And so basically I just pulled all the data from Opendoor and, asked it to, break down the numbers. So this is just an overview for those who have not seen what Opendoor reported. So first of all, key financial highlights for Q2 of 2025, revenue $1.6 billion. That's up 4% year over year. That's great. Beat analyst estimates of 1.5 to 1.57. So they did beat on the top line, right? They beat on revenue. Home sales, just a hair under 4,300 homes sold. That's up 5% year over year, 46% quarter over quarter, pretty significant there. Gross profits, $128 million. Net loss of negative $29 million. Now that sounds awful, but they improved from negative $92 million in Q2 of 2024. So that is an improvement there. It shows that they're making the business a bit more efficient. They're losing less money. That's all great stuff you want to see as an investor. Now, as far as non-GAAP performance metrics, contribution profit of $69 million, margin of 4.4%. That was down a little bit compared to Q2 of last year. And then adjusted EBITDA, this is the thing Eric Jackson and everyone's been talking about over the past couple of weeks. They did allude to a positive EBITDA, and they did report that. It was $23 million with 1.5% margin, and that's the first positive quarter since 2022, compared to $5 million in Q2 of 2024, and negative $5 million in Q2 of last year, and then negative $30 million in Q1 of this year, right? So pretty significant turnaround there for the EBITDA, and that's basically just showing the core business itself is profitable, right? Before you account, depreciation, taxes, things like that, if we're just talking strictly earnings before all that stuff comes out, they are profitable. Now, as far as inventory and acquisition trends, this is interesting. So their inventory ended at 1.5 billion, right? 4,500 homes roughly. That is down 32% year over year and 35% quarter over quarter. So the inventory they have on hand is not a lot. And so that actually plays into the lowered guidance that we ended up getting for Q3, because if you have less homes to sell, you're not going to generate as much revenue, right? And the reason they have not been buying up as many homes partly is due to the fact that, it's not a favorable environment, which is something they talked about on the earnings call. Mortgage rates are very high right now. We don't have any of those interest rate cuts yet. And so they're anticipating continued struggles in the housing market for really Q3, and I would imagine Q4 as well. So their inventory is down. Homes purchased, a little over 1,700 units, down 63% year over year. That's massive. And 51% quarter over quarter. Homes under contract for purchase, 393 units, down 78% year over year. Aging inventory concern. So 36% of homes on market greater than 120 days. That is alarming, right? The fact that they're sitting on the market so long means that the demand for houses is not that high. Q3 2025 forecasts, right? So this is really what sent the stock down on Tuesday and after hours. Revenue guidance, 800 to 875 million, implies a sharp sequential decline and falls well below market consensus, which was 1.2 billion. I mean, the revenue that they're guiding for in Q3 is literally half of what they did in Q2. So that is very alarming, the fact that we got half the revenue expected in Q3. Adjusted EBITDA guidance, negative 28 million to negative 21 million, in contrast to analyst expectations around negative 5 million. Contribution profit guidance 22 to 29 million. Expected to acquire only 1,200 homes in Q3, far lower than models projected, which were more than double that. The projections for home purchases in Q3 for Opendoor was 2,500. So that's very interesting. And then obviously shares fell sharply, 20% in after hours due to that weak forward-looking guidance and just limited home acquisition activity, despite the revenue beat, right? The revenue beat, the top line beat, that looks great at first, but when you really dig into the numbers, that's the main reason why we saw, the stock fall off, despite the positive EBITDA, despite the top line beat, the fact that, they're not buying up as many homes and their revenue guidance for Q3 is half of what they did in Q2. It's not great. So as far as positives, right, they did secure their first adjusted EBITDA profit since 2022, signaling operational tightening, so that's good. Revenue came in slightly ahead of expectations, and positive sequential growth is notable in a tough housing market. Year-over-year improvement and net loss underscores progress in cost control. So the fact that they are kind of tightening the hatches, if you will, from an operational standpoint, we are starting to see the results of that. It's not going to be overnight, but the fact that they got their first positive EBITDA since 2022 shows that they are cutting costs. They're being more efficient with their capital. They're really taking a defensive stance, I would argue. And, because of that, it is allowing them to have a positive EBITDA. And, I think that is a positive sign. Now, areas of concern: sharp declines in home acquisitions. Inventory and contract pipeline raise red flags on growth sustainability. Aging inventory suggests slower turnover and pricing pressure. Guidance markets contraction with sequential revenue and EBITDA declines, posing execution risk. And then valuation remains speculative. Obviously, you've got the whole meme crowd involved with Opendoor right now. So at least from more of a Benjamin Graham investor standpoint, as this GPT is kind of custom made to be, the valuation does remain speculative at this point. Now, as far as context and risks, the housing market remains stagnant with high mortgage rates and low transaction volumes. Management pivoting toward a capital-light, agent-led distribution model marks de-emphasizing of iBuying and greater reliance on agent network monetization. So this is what I was talking about that Carrie Wheeler, the CEO, was talking about in the earnings call, right? Moving away to a more capital-light system that might provide more profitability, slightly better margins than what they were getting on just simply flipping homes, right? And so that's what we have here, is a company that is switching. They're not abandoning iBuying, but what they're doing is they are adjusting to the macro environment, incorporating, real estate agents into the process, and really trying to leverage a piece of this whole home buying and home selling process, being real estate agents, that's really been a part of this legacy industry for a long time. They're starting to realize, hey, we actually have these people for a reason. Let's incorporate them into our business model. And so the fact that they are kind of shifting, management is kind of shifting from that, de-emphasizing iBuying, greater reliance on agent network monetization, that can create some uncertainty for investors, and that could have also contributed, along with the weak guidance for Q3, to the stock price kind of getting crushed in after hours. And then also macro conditions, absent improvement catalysts, continued softness in underlying market fundamentals could pressure the business. Really, one of those catalysts would be, in my opinion, a Fed rate cut. As we get those rate cuts, that's going to have a direct impact on mortgage rates, which will in turn have an impact on demand, which would give Opendoor a reason to be buying up more inventory, because then they can actually sell that inventory, generate higher revenue. So, the fact that they put in for weaker Q3 guidance is not, the greatest. But if we start getting some of these Fed rate cuts, they might be able to actually beat that. And so in conclusion, Opendoor's Q2 results mark a turning point on profitability, but undercut by sharply weaker operational volume and cautious guidance. Basically, it's an evolving value story with progress on margins, but paired with heightened execution risk. and reliance on turnaround and housing demand. Investor caution is warranted given market headwinds, while the direction of its strategic pivot from owning homes to distributing via agents deserves close monitoring. So that's my GPT breakdown of earnings. I hope that definitely helps if you were not able to look at the earnings or be on the earnings call. But basically, all you need to know at this point is that guidance was weak, and that's why we're down. So we are also shifting into more of an agent-friendly environment versus just strictly the iBuyer process. So we'll see how that goes for them in Q3. And, here's the thing, right? Opendoor is clearly a meme stock right now, regardless of how you look at it. I know Eric Jackson doesn't like to hear that, but it is, right? And if we take a look at apewisdom.io, which we always love to reference on this show for, basically what we're looking at as far as trending stocks on Reddit, right? What is actually moving right now? What is, catching eyes of investors? We can tell here that as of right now, Opendoor is still sitting in the top 5 if we take a look at Ape Wisdom. So there is still retail interest on Opendoor, which is a good thing, because here's how I look at it. When you're dealing with, meme stocks in general, typically you don't have any kind of, fundamental basis for, a bullish thesis, right? What I mean is that most squeeze plays are strictly based off of that, and you don't have fundamentals to go off of to kind of back it up or give you an extra, some extra confidence on the bullish side. The thing that's so interesting to me about Opendoor is the fact that this stock in particular kind of has the best of both worlds right now, meaning, yes, it is currently a meme stock. Yes, there's a lot of retail interest on it. It has an insanely high short interest right now, over 20%. But in addition to that, it is also a recovery play. It is also a fundamental play. And so, yes, we did get, the weak guidance, but we did beat on revenue. We got the positive EBITDA. I believe this is a turnaround story. And so the fact that you have both those things going right now for Opendoor, I think is a good thing. So let's take a look at the chart overall. Taking a look at the daily chart, I've been saying for a while now, in my opinion, in the very short term, meaning next couple weeks, maybe next month, if we cannot hold above $2, I think the bull thesis is done for the short term, not the long term, right? But just in the short term. Today, unfortunately, we did close below $2, right? So we're sitting at $1.90 as of the close on Wednesday. And unless we get a nice pop back above 2 and reclaim that on Thursday, it doesn't look that great because of the fact that, you're basically having the bears kind of take over at that point. Now, with that being said, I want to take a look at the options chain and kind of look at some of the notable, I guess, strikes for really this week and also next week, right? What are some areas where, market makers might be forced to buy or sell shares, right? So basically, for those of you who don't know, when you have a ton of open interest on certain strike prices, if the price is starting to move up to that level, let's take calls, for example. If you have $2 strikes and prices moving, up to $2, beyond $2, well, your delta is increasing on those contracts, right? And for the market maker, the individual who sold you those calls, they are a negative delta. So they need to hedge that position. The way they do that would be by buying up shares of the stock. And so it kind of acts as, gasoline on the fire, so to speak, adding fuel to the fire. And so, what we want to look for are some strikes on both the call side and the put side, where we could see market makers on the call side needing to buy shares if price is running up to that level, or if price is running down to certain strikes on the put side, where a market maker would need to sell shares in order to hedge their position. Because again, market makers aren't out there to, turn a profit per se or make you lose, right? Their entire job really is to remain net neutral. And so there's a lot of ways they do that, but when they are attempting to remain net neutral, depending upon the direction the stock is going, it can add more liquidity either to the upside or downside. And so with that being said, if we take a look at the August 8th expiration, the weekly, this is the one expiring on Friday. On the call side right now, you have over 92,000 calls of open interest sitting at $2.50, right? That's the largest one. And then right above that, $3, you have over 80,000 calls of open interest. On the put side, you have quite a bit at $2. You have an open interest of 57,000, and then at $1.50, you have almost 43,000 open contracts, right? And so the reason I mention that is because you could easily see between, now and Friday, basically throughout the rest of this week, basically price kind of pinballing between, I would say, $2 and $2.50, considering those are some of the largest open interests on the call side and on the put side. Now, if we get a scenario where we get a volatile movement to the upside and we break above 250, that's 92,000 calls that market makers are going to need to hedge for by buying shares to remain net neutral because they are short those calls, right? And so just take, 92,000 times 100. That's how many shares they would need to buy as those deltas change. So don't want to get into all the Greeks right this minute regarding options and how they work, but just know in general, if you're looking at an options chain, you see a lot of open interest at certain strikes, those should pique your interest, right? Because of the fact that if price moves up to that point, you could see added fuel just simply from market makers needing to hedge and buy shares or sell shares if it's on the put side. So those are some of the price points for this week I'd be paying attention to. And then August 15th is the monthly expiration. And basically, $3 is the big one on the call side, over 75,000 open interest right now. And on the put side, $2 is also the big interest there, over 73,000 puts at the $2 strike. But in general, if we take a look at the options chain, right, it's still looking very bullish. I mean, the put to call ratio on Wednesday was 0.43. So, basically 2 times as many calls being bought as puts. So, as of right now, the options chain remains bullish on Opendoor, which I find very interesting considering the fact that, we have had this ugly sell-off since earnings. I think that's very notable. The current IV percentile is 44%. It's looking very attractive right now. Implied volatility of 184%, cooled off big time since the run-up we had a couple weeks ago. Now, as far as volume is still looking good. I mean, if we take a look at the 90-day volume average, on Wednesday, we did 1.5 times that 90-day average. So we are still seeing increased volume on Opendoor, which, is a good sign. It means that we are continuing to see interest from, not just retail, but also institutional activity as well. Now, as far as the chart looks right now, yeah, that was an ugly close on Wednesday. In the very short term, we might see some more downside, maybe to 150. We'll see what Thursday looks like. I don't know. But one of the things on a longer term, right, that is very interesting that I've been noticing is that Opendoor, folks, is setting up for a golden cross, potentially. If you don't know what a golden cross is, it is arguably the most bullish indicator that you can get on a stock. And it's just simply when the 50-day moving average, which on my chart is the white one here, when that crosses above the 200-day moving average, which is the yellow one here on my charts. And as you can tell, over the past, 2-3 weeks, the white 50-day moving average is slowly creeping up to the 200-day, right? And so we're getting into a position here, we might see, depending upon what happens with price action over the next week or so, we may be setting up for a golden cross. That is a very, very bullish signal. So I want to throw that out there because, yeah, we had a negative, earnings reaction down 20%, really just been, experiencing a lot of selling pressure since that run up that we had back on July 21st. However, if you kind of zoom out a little bit, we are setting up with some of these moving averages for what looks like a bullish transition. So I think that's very, very interesting and something to keep an eye on. As far as the relative strength index for Opendoor right now, we are currently sitting at 52. It obviously came off a bit more on Wednesday because we had selling pressure. And really, we're sitting at a good point. I feel like the RSI has had time to reset, and now it's just a matter of whether or not we're going to get some buyers stepping back in, see if we can push price back up. The first resistance level I'm paying attention to is $2 and then $2.21. Want to see us get back above that, get back into this channel here between $2.21 and $2.74. If we are able to get above $2.50 or close to it, that's where things might get a little interesting. You might see some market maker, buying to, essentially hedge for all of those open interest calls sitting at that 250 level like we just talked about, right? So we will see what happens throughout the rest of the week with Opendoor. And keep in mind, institutional shares for Opendoor, we're still sitting at over half the float owned by institutions, folks. So despite the fact that we have the negative guidance, there's clearly still a very large institutional presence in Opendoor. And keep in mind, too, the Fed rate decision, the odds for a rate cut in September just keep going up. It was at 80%. I mean, a week ago was basically a coin flip. We talked about it on the show last week. We're at like 46%. Now it's at 93%. We're essentially baking in a rate cut in September. That's the beginning of good things for Opendoor when it comes to the housing market. So that's what I got for you on Opendoor. Let's transition into more of a macro picture for what we've been seeing this week. First of all, if we take a look at the S&P 500, on Wednesday we closed at 63.45, creeping back up to that 50% Fibonacci extension level I've had on here for a little bit now. And, looking good. We're back above the 20-day moving average for the S&P 500. And, we had a couple days of selling pressure, but we are regaining that now. And the equity markets, according to that, look pretty good. And the RSI on the S&P was able to kind of reset. We were up in the 76 range, a bit overbought. And as of right now, we're sitting at 58. So the RSI has had some time to cool off on the S&P. And this thing could clearly keep ripping, and we could easily see a new all-time high. Quick check-in on the tech-heavy NASDAQ via the Qs. And same thing, setting up very good. We're back above that 20-day moving average that we got below earlier in the week. And tech looks very, very solid. Obviously, it's had a lot of help with some of the earnings that have been coming out. Palantir, which we'll get into, they crushed it. And so, the Qs overall looking fantastic there. RSI on that sitting at 60, a little bit hotter than the S&P, but still looking fantastic. Quick check-in on the Russell 2000 via the IWM, back above the 200-day moving average, which is great. And this is now officially getting a golden cross. So I was talking about the golden cross potential for Opendoor. This is an example of it on small caps on the Russell 2000 ETF IWM. And so that literally happened basically yesterday. So we got the beginning of a golden cross here. You got the 50-day moving average crossing above the 200, and that is the most bullish indicator you could possibly get. So we are seeing small caps catching up to tech and really the overall market. And quick check-in on the VIX. The VIX right now is sitting at 16, was down 6% on Wednesday and back below the 200-day moving average. So, we got that spike last week in the VIX. It was above 20 briefly, but now starting to come back off, and the market seems pretty stable as of right now. Quick check-in on Bitcoin at time of recording. Bitcoin is down 0.3%. We're sitting at 114,704 right now. All-time high on Bitcoin, a little over 123. Had some weakness over the past couple days, and it looks like it's consolidating now. You got support down at 112, but overall, crypto in general is very bullish right now. Bitcoin is a risk-on asset, so as the market continues to rally in this risk-on environment, I would definitely expect Bitcoin to do the same. By the way, this is TradingView, awesome platform. If you're interested in it, I got a link in the description. Make sure to check that out and get $15 off. All right, let's move on to some of the macro news that we got from Wednesday. So first of all, Trump raises India tariffs to 50% over Russian oil purchases. This according to CNBC. The White House announced Wednesday that it is imposing an additional 25% tariff on India, bringing the total levies against the major United States trading partner to 50%. Quote, I find that the government of India is currently directly or indirectly importing Russian Federation oil, President Trump said in an executive order. Quote, accordingly, and as consistent with applicable law, articles of India imported into the customs territory of the United States shall be subject to an additional ad valorem rate of duty of 25%, the executive order reads. The new tariffs are set to go into effect in 21 days, according to the order, while the previously announced 25% tariffs are set to take effect on Thursday. Trump's new tariff rate on India is now among the highest levies on any of the United States trading partners. That is massive. Trump's new tariff rate it's the latest sign that Trump is following through on his threat to punish countries that buy Russian oil, as he's increased his rhetoric in recent weeks over President Vladimir Putin's invasion of Ukraine. So obviously we know that President Trump has been trying to get this war between Ukraine and Russia to end for quite some time, and really has been trying to put the pressure on Vladimir Putin to do just that, right? To end the war. And the fact that he is basically, he basically said anyone who's dealing with Russia, they're going to pay, and he's sticking to it. He's being a man of his word as it relates to this. And the fact that India is, supposedly buying oil from Russia, we are now punishing them with higher tariffs. So over 50%, tariffs to 50% on basically this whole deal with Russian oil. I think that's massive. And so, as far as India's response to that, they basically said, quote, extremely unfortunate that the U.S. should choose to impose additional tariffs for actions that several other countries are also taking in their own national interest. We have already made clear our position on these issues, including the fact that our imports are based on market factors and done with the overall objective of ensuring the energy security of 1.4 billion people of India. So, they basically just defended what they were doing, but President Trump has been very clear about what he wants to do as it relates to any kind of relations, interactions with Russia. And so India currently is paying the price unless they kind of, switch gears. So we will keep tabs on that. Obviously, we're still waiting to see the U.S. get a deal done with China. And for the most part, I believe all letters have been handed out to countries. And so we're still seeing the dust settle, so to speak, as it relates to tariffs. So we'll, of course, be keeping tabs on that. Now, let's move on to some news with Apple that came out on Wednesday. Apple announces additional $100 billion in U.S. investment following Trump iPhone tariff threat. Apple revealed plans to invest an additional $100 billion in U.S. manufacturing commitments during a press event at the White House with President Trump on Wednesday. The move follows Apple's prior $500 billion investment in U.S. spending, which includes working with partners to build an AI server plant in Texas. Shares of Apple climbed more than 2% following the news. Apple says that the $100 billion announcement includes its new American Manufacturing Program, AMP, which the company says will incentivize global companies to build critical components in the U.S. The tech giant says its first AMP partners will include Corning, Coherent, Global Wafers America, Applied Materials, Texas Instruments, Samsung, Global Foundries, Amcor, and Broadcom. Quote, I love that you are doing this. I love that, Trump said during the announcement, later adding, we've got the hottest country anywhere in the world. So this is pretty big news. I mean, Apple, I think we covered it the other month, had already, basically said they were going to invest a substantial amount of money into the U.S., $500 billion. And the fact that they're adding an additional $100 billion, I think, is massive. It definitely seems like President Trump put some pressure on Tim Cook to basically get this done. And also keep in mind that Apple, they may be impacted by some of the tariffs that are coming to India because a majority of the iPhones that they put together are happening in India. So Apple's announcement also comes as the company prepares for a new 25% tariff on goods destined for the U.S. from India. That's in addition to an existing 25% levy Trump previously said he would apply to the country's products. So they basically have an additional incentive at this point to come to the U.S., given the fact that one of their main countries that they're building iPhones in now just got waxed with a 50% tariff from the president. So very, very interesting indeed, and we'll be keeping tabs on that. But if we just take a brief look here at how Apple held up today, I mean, really Apple in general has kind of been range bound for a little bit. If we zoom out to a 1-year chart, it's basically been range bound since the late April. It had the rebound from the reciprocal tariffs, and it's basically had resistance right around 215. Obviously, Wednesday was a pretty nice green day for the company in light of that news. And so we'll see if Apple can break out. It is currently below the 200-day moving average. But as you can tell, Wednesday was a great day, and even in after hours got another bump all the way up to about 219 when it had closed regular trading hours at 213. So we will be definitely keeping tabs on that. Apple, of course, part of the Magnificent Seven, one of the biggest companies in the world, and so definitely worth paying attention to. And now for another company worth paying attention to, how about Palantir, folks? This thing continues to skyrocket. This, according to CNBC, Palantir tops $1 billion in revenue for the first time, boosts guidance. Palantir topped Wall Street's estimates and hiked its full-year guidance due to the artificial intelligence boom. The AI software provider's revenues grew 48% during the period and hit $1 billion for the first time. The software analytics company has seen a boost from President Donald Trump's focus on cutting government costs. So, Palantir came out with earnings on Monday. They just continue to rip. It's really incredible if you've been paying attention to it for a while now. But, I mean, this company just continues to defy all expectations, and they're doing all the right things right now. I mean, if you take a look at where they were at a year ago, it was $25 a share, and is currently sitting at 180. And this chart just simply goes up and to the right. So Palantir killing it right now on a relative momentum basis, though. If we look at the RSI, it is a bit overbought right now, currently sitting at 77, which, makes sense given the fact that they just beat earnings. And you got a lot of people kind of flocking to get in right now. But Palantir is just freaking crushing it. If we take a look at some of the numbers that came out, earnings per share, 16 cents adjusted versus 14 cents expected. That's a beat. Revenue of $1 billion versus $940 million expected. That's also a beat. And they're doing all the right things with AI. Obviously, we got this AI frenzy going on in the market right now, and they just continue to crush it. They said, quote, "We are planning to grow our revenue while decreasing our number of people," CEO Alex Karp told CNBC's Morgan Brennan in an interview. Quote, "This is a crazy, efficient revolution. The goal is to get 10x revenue and have 3,600 people. We have now 4,100 people." Very interesting. So they are not letting off the gas at all as far as efficiency, as far as their aspirations for revenue. So definitely worth paying attention to. As far as the long haul, this is something I would definitely be interested in from an investment standpoint. Maybe I just wouldn't want to buy it right now, given how overextended it is. I would be expecting a pullback eventually, but hey, when that's going to happen, who knows? Because right now the market is very, very hot for Palantir. And we've even seen, other investors getting involved in it. I know Cathie Wood, one of the more notable ones. And, there's a few other notable bulls on Wall Street that have just been continuing to sing Palantir's praises. So definitely we're paying attention to, but that was really the, knock it out of the park earnings that happened on Monday. That's Palantir. And now let's move on to the economic calendar. We had PMI numbers that came out on Tuesday, August 5th, that really were not that great. We had a 10-year note auction that happened on Wednesday. And taking a look at Thursday, we got initial jobless claims at 8:30, and you got a 30-year bond auction happening at 1 p.m. And that's really about it for this week. Not a whole lot going on there. And then as far as next week, you got CPI, PPI data coming out and core retail sales. That should be interesting. But yeah, that's about it for Thursday as far as economic data you need to be paying attention to for some of my more active traders out there. Again, initial jobless claims, 30-year bond auction could be a volatile market event at 1 p.m. And as far as any earnings coming up rest of the week, so on Thursday, before the bell, Eli Lilly, you get Celsius, Sony. After the bell on Thursday, some more notable ones there, SoundHound, Pinterest. And then on Friday, Fubo TV is going to be reporting. Remember, they had that deal with Disney beginning of the year. Want to get some updates and see what's going on with them. And Wendy's reporting and CPI. Yeah, so you can see here, this is Earnings Whisper. Make sure to check them out if you want to get up to date on all the earnings coming out. So folks, that's what we got for the midweek check-in. So look, Opendoor, as of right now, again, weak guidance. They beat on revenue. It's really a mixed bag, honestly, when you take a look at it. We're really just going to have to see from a fundamental standpoint what Q3 looks like for them. If we can get a Fed rate cut, how will that impact some of those estimates they have for homes that they're going to be buying? What is it going to look like with some of these partnerships they're trying to do with other, real estate agent companies as they try to, transition some of the business away from just simply buying and flipping homes and partnering with real estate agents. So from a technical standpoint, look, we got to hold two for the bulls. You got to hold $2, especially that. And really, ideally, over 250 is really what I'm looking for. But hey, let's see what the rest of the week looks like. We still have high short interest. I'll, of course, be keeping tabs on it. Appreciate the support. We will be back as always for our Sunday market prep video at 7 p.m. sharp. If you found value here, make sure to like, subscribe, follow wherever you listen to podcasts. And folks, as always, remember, plan the trade and trade the plan. Have a good one.